If you're new to Village Wealth, we're an acquisition management platform. We help people access financing. We provide guidance and community. Like I said, the new app that's coming is going to be able to help us enhance our community. And our plans and programs offer guidance at a variety of stages where people are at throughout the process, as well as our marketplace. So we have an active marketplace. I'm going to go into it in a little bit of detail here today, where you can find businesses for sale, or if you're selling, or if you're a broker or an M&A firm, you can find and access buyers, and what it means as a buyer to build your profile and why it's important to set that criteria. A little bit of background about myself. My name's Liz McCrae. I'm a co-founder and president of Village Wealth. I've had 2 exits. And my journey in entrepreneurship started just over 12 years ago, when my husband and I thought it would be fun to get into business and attempted family succession with my father. He owned a potato produce exporting company in little old Prince Edward Island, and he exported to the Caribbean. And we called him up one day and said, "Hey, Dad, what if we started working on your succession plan? What if we took over the business?" He hadn't made the right decisions throughout his ownership in order for it to be transferable. And for a number of reasons, we weren't able to take over the company, and that wasn't an option for us. So we did the next logical thing that we thought people did when they got into entrepreneurship, and that was buying a franchise. So we didn't know that buying an existing business was something that you could even do. And that's why I have so much passion and purpose in this space, because that's what we should have done. So instead of going the existing business route, we went into buying a franchise. It took us 4 years to get out of that business, after learning very early on that it wasn't a fit for us and it wasn't going to meet our goals. And we went into substantial debt throughout that experience. And when I sold it, I was taken into the brokerage that helped me sell that business, and I became a business broker. And very early on, I realized that this is a complex space, and that a lot of the businesses that are preparing to sell or wanting to sell are not in a sellable state. And so at that point, I had taken over the business brokerage, and we transitioned it into a transaction advisory and exit planning company. And we started working with people to build their companies to be sellable. And around 2020, I ran into my partners with Village Wealth, and we thought, well, there's a lot of activity happening to support business owners in the ecosystem, but nobody's really looking over here at all the people wanting to buy companies, and there's not a lot of support or education and guidance and access to capital, easily accessible access to capital out there for them. And that's how Village Wealth was started. So I abandoned the sell side and I came over to the buy side, and we started building Village Wealth 4 years ago. And we've come through a number of iterations. If you've been with us for a few years now, you've seen a few changes along the way. And today you'll see some of those iterations as we move along. So content that we're going to cover today touches on the overall acquisition process. That's kind of the basis of our content today. We're going to talk a lot about terminology. So I really encourage people, if you're hearing words and terms that you're not familiar with, this is part of the learning curve. Write it down. Google it. We also have a terminology resource that we can send it out afterwards if people are curious about that. So if you'd like it, let us know. We're going to be touching on access to capital and how financing works in this space. We're going to talk about search methods, and we're going to talk about how Village Wealth helps with all of these things and where we come into play. So jumping into the process of buying a business, at Village Wealth, we break it down into 5 modules. So the first stage being acquisition planning, module 2 being search, module 3, evaluation, 4, the letter of intent, and 5, financing to closing. I'm going to start with module.
Liz, I'll just interrupt quickly. Yep. Your slides are not progressing.
No. You know what?
Sorry, so I'm just realizing.
That's okay. I have a really funny story while I try and fix this. So I'm going to stop sharing my screen for a moment. So I had a dream last night that it took me an hour to figure out my slides. And what was playing to all of you in the background was videos of me and my friends during university, which were half embarrassing videos. And it took me an hour to figure out my slides, and you all hung out for the whole hour. And then finally, at the end, Bridget just jumped into Q&A and took over. And I woke up this morning at 5 a.m. and that was
It's
my
not
dream.
like a it's not like it's your first rodeo either.
No, I do this
Too
all
funny.
the
Okay,
time.
we see them now.
Oh, they're moving?
Self-fulfilling prophecy. Yeah, they're moving now.
Okay. So where I should be now. So we're an acquisition management platform. Here's a little bit about me. This is what we're covering today.
It's good to review. It helps the info stick.
And it's and here's all the modules that Village Wealth works with.
Awesome.
Thanks, Bridget. Thanks for pointing that out. It was great.
Sorry it took me so long.
That's okay. um, so jumping into module one, acquisition planning. If anyone's in this state right now, you're in learning mode and really understanding and learning the process. And I tell people through our coaching programs that, you're never going to have all of the answers to acquisitions all at once. So sometimes people stay in this learning phase for too long because they're absolutely paralyzed to start taking action and moving through the process, because they still feel like there's so much to learn. And really, you learn by doing in buying a business, and you learn by moving through the stages and learning as you go. And you kind of have to get comfortable with being uncomfortable. So some of the recommendations that we have when you're in learning mode is, read the books, listen to the podcast, access resources from Village Wealth. So two of our highly most recommended books would be Buy Then Build and the HBR Guide to Buying a Small Business. Podcasts we recommend are Acquiring Minds by Will Smith. Love that podcast. He interviews stories of people who have bought businesses. Built to Sell Radio is by John Warlow. It's sell side, so it's all stories of business owners who have sold. And in listening to these podcasts, you start to get familiar with the deal structures and the various financing methodologies that people use and the terminology. So really, if you're going to go down this path, you want to immerse yourself in the content and the language of this space. With Village Wealth, we've got a short video, high-level masterclass series where we've got a business broker, Scott Duke, who did a wonderful series for us on the basics of buying a business. And then every month we run a webinar. So we invite guest panelists for a 1-hour discussion. And we've got all the recordings in Village Wealth's resource section that live there. So, and that happens every month. So if you're just new to us, definitely sign up for our email so you get notified of the webinars that happen. The next piece is learning about affordability, and we're just going to jump right into it. We're going to jump right into the heavy content here. So it's one of the most common questions that we get is, how much do I need to buy a business, and how much do I need to put down, and how does financing work? So typically what we see is personal capital, your down payment for a business, also referred to as buyer's equity, here we are talking terminology again, can range from 10 to 15% down. And why it's 10% as a minimum is because banks really want to see you have skin in the game. So this affordability, when at the top it says for individuals, if you're a corporation that's looking to grow through acquisition, the capital stack can look differently. If you are raising capital and you're starting a fund, you don't necessarily have to have 10% of your own money in that fund. You can raise from investors. Today, we're mostly focused on individual buyers who are buying a business for themselves to own and operate. And typically in that situation, the banks want to see a minimum of 10% down. They want to know that you're committed. They want to know you have skin in the game. And even if you're raising money from family and friends or other investors or doing seller financing, which we're going to get into, they still want to see that you have funds in of your own. So that's the buyer's piece. Institutional debt in Canada, typically we're seeing the banks do about 50 to 75%. So an easy calculation of this range is 2 times your personal capital for what you've got. So here's a simple example at the bottom. If you have $250,000, your range of affordability, 500,000 to 2.5 million. Easy numbers. Once you have an idea of your capital, then we'll get into your search criteria. So here's a simple example, 25% personal capital. On the high end, if the banks will do 75%, they won't always do 75%. It's really on a case-by-case basis, and they will analyze the business quite heavily from a risk perspective. If they're seeing concerns or inconsistencies in the business or perceiving it is higher risk. They might lend less. Um, and this is just a visual, simple visual demonstration. For the personal capital in that 25%, it doesn't all have to be your own money. So if you are raising from co-investors for your down payment, again, you may have more than 25% at the end of the day. But in this example, lenders are doing 75%. You're between you and the co-investor, you're doing the other 25. Who can you raise from? So we see people raising from a number of different parties, family and friends, angel investors who are typically accredited investors. So if you're not familiar with that term, that might be a good one to look up. Accredited investor is someone of a specific net worth who can invest in different vehicles. People who are buying businesses also get funds in some situations from private equity groups or family offices. And where really the process is once you find an opportunity and you're going to move on it, and this is some people will go to investors before they've found a business to buy, or some people will go after they've found a business. Typically they do start to have more traction with investors when they've found a business, and then they can present the business itself to the investors, and they know what they're investing at that stage. And like any capital raise, it starts with pitching the opportunity and the return on investment to investors, negotiating the terms of how much equity are they going to have in the company that they are buying with you, executing a term sheet, and always recommend working with a lawyer, and the lawyers can help you through a lot of these pieces. So it's not an avenue, it's not a path that everyone takes, but it is very common in what we see. The other piece of the financing stack might be vendor financing, which is, I have a definition of it here for you. I'm not going to read the full definition, but again, you'll get access to the slides in the recording after this. So one combination we might see might be that there's 10% personal capital and the seller is financing 20% and the lenders are doing the other 70. So, buying a business can look many different ways, and it's not, like you're buying a piece of property where you have your down payment and the bank does the rest and there's two parties involved. Sometimes there can be multiple parties involved in buying a business. So for vendor financing, it's a form of debt that allows the buyer to hold back a portion of the purchase price as a debt to the seller. So it's essentially like you have two loans. You have one loan to the bank and you have one loan to the seller of the business. Typically what this ranges from, we get a lot of questions on this, is how much do sellers finance? 10 to 20% is typically what we see. We've heard in some of our webinars when we've had M&A firms and we've got banks in, that they're seeing as much as 30 and in some cases 50%. If it's not, being a delight to the banks, and the banks maybe don't have the palate to do the full acquisition, or maybe they're struggling with doing the deal at all, then that's where you see vendor financing coming in if there's an issue, and maybe there was issues in the financials, and you just can't get bank financing. That's where we typically tend to see more vendor financing, and we're really hearing from the banks that they really want to see around 10% vendor financing, because they want to know that the seller is committed to the business. They're committed to the transition period, and they really do believe their company is going to thrive and survive after the sale. So the banks really want to see some skin in the game remaining from the owner. There is sometimes some conditions that the banks put on that, though, is that sometimes the banks require that the seller doesn't get paid their note until after the term of the bank's loan. So what that means is if a bank's loan is 5 years and you can't pay the seller until year 6, sometimes this is a big shocker for a business owner to go, wow, I thought I was going to get all my money at closing, and all of a sudden I'm not getting it for 6, 7, 8 years down the road. So there are some requirements and contingencies around vendor financing that are always a conversation. And there are also things to consider from a tax perspective for both buyers and sellers. So when structuring these situations, they're a good party, a good advisor to have at the table as these things are getting planned out. Typical interest rates that we're seeing are anywhere from 5 to 10%. If you can negotiate a lower interest rate with a seller than you can with the banks, that can be in your best interest as well. And it's some of the reason that we are seeing people do more vendor financing is because they can negotiate better interest rates than they can with the banks right now, while interest rates are still high. Just another example. I'm a visual person. I like pictures. So here's another example of 10% personal capital. Co-investors may be in this situation coming in for 15. The vendor did 20. In this situation, the lender was like, the deal's a little bit not clean. We can only do 55%. And in that case, the vendor, that's where they were maybe brought in for 20%. So in this situation, maybe this isn't how the deal was originally negotiated. Oftentimes we see that there's a retrade or a renegotiation after the lender's been brought into the deal. And usually the banks won't necessarily, like pre-qualification doesn't usually happen with someone's first acquisition. And the banks really want to see you have a business that you're looking at that is under offer before they'll tell you what they're able to do on the business, because they need to see all the documentation on the business before they're really able to give a true picture of what they can lend. And so that's why sometimes it's a little cart before the horse, because you're negotiating on this deal that you don't fully know how much financing you can get. And that's where I said earlier on is sometimes you're moving through this process not having all the information and getting comfortable with being uncomfortable in some situations, because you have to negotiate the deal with the seller sometimes before you have the lending all figured out. And sometimes that's where once the banks get in and they do their due diligence, sometimes they're not able to do as much as you thought they might be able to do, and you have to go back and negotiate with the seller, or you end up ponying up more of your own personal capital or bringing more in from co-investors. So those are things that we end up seeing. Once you kind of have an idea of what you can afford based on your down payment and access to other investors, that's when it's really important to establish your search criteria and get really tight as you can on these pieces, and are getting good at articulating what these pieces are, what locations and regions you're willing to search in and which ones you're not, the industry and sectors that you're willing to look at and which ones you're not. A lot of people start out agnostic. A lot of people think, well, I'm looking at anything. But when you get deeper into that, maybe you're open to a lot of different industries, but there's some industries that you're an absolute no about. And so even knowing what you're not willing to look at and what's not a fit for you helps you narrow down what you will look at. Size of business, again, maybe it's from an employee standpoint and a team standpoint to the size of the valuation and how much you're willing to pay. Articulating these points are really important. Your role in the business, what role are you willing to play? What role will you replace for an owner that's leaving that business? Getting really good at articulating what that means for you. It's personal for everyone, but as you start looking at businesses for sale, you start to pick up on cues of how the business is operated as to whether it's a fit for what your goals are. Getting really clear on what you bring to the table. If you've had other careers and other backgrounds, you're pulling experience from each of those career pieces that you've had previous to buying a business, and getting good at promoting yourself and explaining what you're bringing to this company. The banks really, really, really put a lot of concentration on who you are as a buyer. They don't look 100% at the business that you're buying. They look at who's purchasing it and who's the new management team coming in. It's a very important piece. The other person that looks at that is obviously the business owner, who is leaving you to run their team and their people who they've built up over years, who is really a meaningful piece of the sale to them. Is, are you going to be able to take care of my people? And the other party that looks at your background and who you are is the landlord. They really want to know that you've got experience running businesses, or if you haven't run a business before, but what other experience help you run this business? So you're going to have to get comfortable with promoting yourself. You're a salesperson for yourself moving into this process. And the other reason that everyone wants to know is, why are you motivated to buy a business? What is motivating you? What do you want to get out of this? Why are you in this space? And that's going to be a common question that comes up. Once you have an idea or even some of a sense of this search criteria, that's when you can enter our marketplace. So if you decide that you are journeying down this path, that's when you can start to use Village Wealth's marketplace. So buyers in our marketplace are searchable. Anyone selling a business can search for you. Once you build that profile is designed to be anonymous. So we see lots of people using first names, or if you have a very unique name, like my son's name is Lethan. I have apologized to him many, many times that he's never going to find his name on one of those like keychain things at the ticket stores. He's come to terms with that. So some people use middle names or code names. But those, anytime you build a profile on Village Wealth, that is visible to anyone else who's on the marketplace to see. Our buyers in our system are supported by the community and the initiatives that we run, and you're considered vetted. So we talk to everyone who's in the marketplace. We make every attempt to talk to everyone in the marketplace to understand that you're here for the right reasons, and that you're on the right marketplace, because no marketplace is created exactly equal either, which we'll get into. Sellers who use the marketplace are business owners, brokers, and M&A firms, and it is free to use. So we have new sellers joining the marketplace every day, actually, and it's a two-sided marketplace. What's different about our marketplace is that anyone listing a business can choose whether it's public or private. So if you are in our marketplace and you're seeing deals, you're not seeing all the deals on Village Wealth, because the power is with the seller as to whether they have published and let you know about them or not. From time to time, you might get a message from a seller who you didn't know they were on the platform, and you're going, well, I can't find this listing, it's not on the marketplace. It's because they haven't published it, but because they can see your profile, they've chosen to reach out to you. So that's why it's so important that you complete your profile on Village Wealth, because people are looking at you. And there is an algorithm that is based on the information that you put into your profile. The search criteria that you've set up on Village Wealth pairs you with sellers when they create an opportunity, and it will match you. So if your search criteria at any point changes, you want to update your Village Wealth profile to make sure you're getting the right deals, opportunities that fit for you. And that's how the marketplace works. So this is a bit of a snapshot of what your search criteria looks like in a Village Wealth profile. Your profile is searchable and it's shareable. So there's a button where you can share my profile. You grab the link, you can send it out and use it with your network. If you're sharing with people that you know that you're looking to buy a business, or you're talking to bankers and lawyers and accountants that you're looking to buy a business, you can share the profile that you build in Village Wealth with anyone in your network. If you're wondering how to get started, there's a sign up button on the top right-hand side when you visit our website. And there's lots of other places you can click that'll take you to the same place. But if you're wondering how to get signed up in the marketplace, check it out in the sign up button. And this is what sellers see. So they see that they can put in different search filters, find qualified buyers for your business all in one place. So we're constantly looking and telling kind of the sell side that, hey, we're here, we've got buyers, and we're trying to bring deal flow to you. And this is how a seller will see the profiles. So this is, again, you can see on the top, this is Trevor. He's looking for a business from 1 to 4 million. So again, understanding your affordability so you can put it in your profile and really articulate your search criteria. So all of those pieces go into a profile. These people have been financially verified too. So they've been verified for proof of funds for their down payment, which gives people a little bit of extra credibility, and it gives you a badge. It also keeps you at the top of the search results. So that's one reason why you might want to get verified, but it is optional. It's also a little bit challenging for people to get verified when they're raising capital from other investors. Building your advisory team is something we recommend doing earlier on. The lawyers are not all created equal. If you've bought a home or a piece of real estate with a lawyer, and they say, hey, I can do business transactions, it might not hurt to talk to a few other lawyers to make sure you're with the right lawyer for a merger, and M&A stands for merger and acquisitions. Experience is the name of the game. If your lawyer does a deal, once or twice a year, it's different than working with a lawyer who does it every day. They'll be able to work faster on contracts and agreements. They may know different negotiating tactics or different ways to protect you. If this, then that kind of thing. When they come in, typically the lawyer comes in to review the letter of intent. If it's not your first letter of intent, usually people get familiar with writing them themselves and sending them out and drafting it. But if it is your first time, usually people will at least have a lawyer review the letter of intent, if not draft the first one that they do. And the lawyers will always tell you that they want to review the letter of intent just to protect you, and for very good reason. Not everyone does it, but because the letter of intent is non-binding, but it is best practice to have it reviewed by the lawyer. The lawyer's also there for legal due diligence later on in the process, and they're absolutely the one that's going to be there to draft the definitive purchase and sale agreement, which, as we get in later, is the binding part of the process. You want to find a good accountant that can help you with financial due diligence. Again, if they have acquisition experience, you want to work with someone who does this on a regular basis, as compared to someone who, you know, is doing it on the side of their desk or doesn't do it all the time. They'll just work that much more efficiently for you. Mentors and peer groups are fantastic. Village Wealth has some. We do monthly roundtables with our members. It's just no transaction is the same, and everyone's experience is unique. So really having a support system is important, and having people, the ability to throw things off of people is really valuable. And I've thrown evaluator in here because we often have advisors who attend our sessions and they go, well, you didn't mention evaluator. It can be something that buyers bring in. Usually evaluators are brought in more on the sell side to establish kind of a, you know, an anchor to the asking price. Getting an opinion of value, you know, is this overvalued, undervalued? Where am I at here? From evaluator is definitely an option that you can go to bring an evaluator, but not all people do. So it's up to you, depending on your level of comfort in the space, or if you're new or not. And the banks can also speak to the valuation as well if you're having conversations with the lenders. Okay, moving into module 2, methods of searching, pitching yourself, and engaging with sellers. So this is a busy slide, but I wanted to leave it with everyone as you're getting copies of the presentation, so you can kind of digest it later. The methods of searching, there's essentially about 4 methods of searching. And it's not, if you're really new to this space, then you may think of it, a lot of people come into this space and they think, well, this is like real estate. Like the seller's going to have an agent, and then I'm going to have an agent, and I'm going to find one business broker, who are the title of people who sell small businesses. And they're going to take me around, and they're going to help me find a business to buy. But it doesn't really work that way. So some business brokers and M&A advisors do operate and offer a buy-side mandate. Usually it is a high engagement fee. I've heard $5,000 as an engagement fee plus a success fee. So it's not an industry where the sell-side advisor shares commission with a buy-side advisor. So if you do want to hire a business broker, an M&A advisor, you end up paying their fee, because it's not paid by the sell side. So most people will conduct a search and they'll look for a business on their own without hiring someone to do it, because it does get quite costly. If you're a corporation that's growing through acquisition, it might make more sense, because typically if you're a corporation growing through acquisition, you're going to go through the proprietary search. So starting out, where most people start, is the marketplaces. Not all marketplaces are the same. Usually each marketplace has a niche, and it may be the industry. There are marketplaces that just sell e-commerce businesses. There are marketplaces that just sell startup businesses. There are marketplaces in Canada and marketplaces that just sell US companies. There are marketplaces that only sell businesses under a certain value, or marketplaces that sell businesses just only over a certain value. So for example, Axial is a marketplace in the mostly US based, but they sell businesses, I believe, 500,000 in EBITDA and above, versus acquire.com is one that sells startups. So we do provide a list of marketplaces in Village Wealth's programming, so we can help you navigate which marketplaces are which. Our marketplace is a tool. It's not going to replace your search. It's not going to do it all for you. It's just a tool in your search. Marketplaces often sell smaller businesses. Typically, it's the business broker space. So you can see in column number 2 in the second box that business brokers often sell businesses under 3 million in value, where an M&A advisor will sell businesses 3 million and up. But there's a bit of gray area here. They kind of mix between the 1 and 10 million dollar price point. There can be an overlap of the type of advisor that sells businesses. Every advisor has their own businesses that they sell. They don't sell other people's businesses typically. So that's where you as a buyer end up going to each business broker and each M&A advisor, building a relationship, getting on their list. Every business broker and M&A firm has a short list of buyers who they know, they're vetted, they're serious, and they know that they can go to. So you have to do the work to get on the private list of all the business brokers and M&A firms. The other category of people that sometimes sell businesses are accounting firms that might take on, a few a year, or they might do it on the side of their desk. Commercial realtors are often, depending on the province, some provinces, business brokers have to be licensed as commercial realtors. In BC, I think Nova Scotia and Ontario. And so commercial realtors might have opportunities as well. So this is where it's time consuming. You hear people looking to buy a business anywhere from, a few months to a few years. So getting good at finding businesses and having them come to you is something, it's a bit of a process to build. Relying on just marketplace is going to limit all the businesses that you're seeing. And also learning how to use your network is really important. If you can use your search criteria and share that out with your network, everyone knows, one accountant or one lawyer kind of thing, and you're growing your network of accountants, lawyers, financial planners, business coaches, anyone who touches a business owner and has a business owner in your network. You really want to spread the word that you're looking for a business to buy and what you're looking for, and make it easy for people to get in touch with you and contact you back. So again, another reason where you can leave your profile with them. If you are searching anonymously and you're still employed, we see a lot of that where people are fully employed and they can't publicly announce that they're looking for a business to buy. That's where, sometimes your profile can come in handy because you can still look anonymously, or there's some other strategies that you can employ to just keep it kind of on the down low. But it can make challenges in your search. And the last strategy is proprietary search, which means contacting companies directly or approaching them. You're in the store, you're in the shop. Hey, oh, you're the owner. Hey, have you ever thought about selling? We've had people have a lot of success just having a casual conversation or planting a seed, and then over time, maybe they'll get a call back saying, hey, yeah, I remember you asked if I'd ever be interested in selling. So it's certainly a process that we recommend people following. Some people follow it more aggressively. Some people only do proprietary search. They only contact businesses directly, versus other people who look for businesses will only go through business brokers. It's an entirely different approach. In one of our programs, we teach the difference between these approaches and why you might choose one path over another. I don't know if you can hear her scratching. I have a new puppy. She's leaving the room here. You hear some background noise. Moving on is pitching yourself. So we talked a little earlier about, bringing your background and experience into the conversation. You end up pitching yourself in this process to brokers and sellers. You pitch yourself to business owners. As much as you're exploring businesses that you're looking at, they're questioning who you are. They're questioning your degree of seriousness and credibility, and you are building trust and rapport at every interaction you have in this process. People who sell businesses as a profession talk to a lot of buyers. And so you have to get good at standing out and differentiating yourself from everyone else that they're talking to. As a business broker, I used to get contacted on a weekly basis from a handful of buyers, and it was the same conversation every time I talked to a buyer. It was, I'm looking for an established company with good cash flow. It's got employees, trained employees, good management in place. And they're hearing this same conversation from almost everyone they talk to. So you've got to get good at speaking to yourself and finding out what makes you different, and making your approach personal being human is something that we find really helps in differentiating yourself and bringing forward more of your purpose in why you're buying a business. And then even how you carry yourself through interactions, follow through, do what you say you're going to do, maintain momentum. If you're seriously interested in a business and one specific opportunity, you sometimes have to drive that momentum. Don't wait until someone gets back to you. If they haven't gotten back to you, you get back to them first because they're busy. And if they're talking to you and they're on the market, they're talking to a lot of other people as well. You're going to be the one that has to maintain momentum. So a little bit about cadence there and keeping up consistency. Engaging sellers, if you're new again to this process, typically the process looks like this. Again, each seller, whether it's a business owner or a professional you're dealing with, they have their own process. So ask when you first engage with a business broker. That's where you ask, hey, what's the process that you follow here? What am you know what are the next steps? What am I getting into? Typically, it looks like this, where you're expressing interest in a company either through responding on a marketplace or responding to a lead that you got, or approaching the business owner again. The second step is they're typically going to ask you to sign a confidentiality agreement, an NDA. Step three, they're going to ask you, you're going to want to have an initial meeting either with the business owner or with the broker. Sometimes you don't get to talk to the business owner until later in the stage. So again, ask the broker what their process is. You can ask to talk to the business owner up front. Essentially you want to talk to the business owner as early as possible if it's something you're interested in. If you're kind of not sure, then maybe follow their own process. But as soon as you get an inclination that this is a business that you want to buy, that's when you want to start building the relationship with the owner as quickly and as deeply as possible, especially if there's other buyers at the table. They're going to share information with you. It's typically called a confidential information memorandum. That is the technical term. You can Google it and find out what's typically in a confidential information memorandum. The acronym is a CIM. So if you hear, the CIM, or have you gotten the CIM, that terminology rolling around, that's what a confidential information memorandum is. They're also referred to as buyer's presentation, confidential business review, business package. There's a number of different names that they do go by, but the technical name is a CIM. Follow on Q&A is, okay, I've reviewed the information that you've provided, which usually does include financials. We have some people that say, hey, the broker's not giving any financials until I give an offer. Usually they do provide financials before an offer is requested. But again, get clarity on who's selling the business and what their process is. You can push back, but they might also push back as well. So see how far you get. Every seller is different. Then they're going to ask you for submission of a non-binding letter of intent. That's where things get real. So you can do quite a bit of exploring throughout the business before having to put in an offer. That offer is referred to as the LOI. I'm going to try and motor through here the rest of the pieces because we're running out of time. I knew we had a ton of content to go over today, so I'm going to try and fast track this. Module 3 is fit, affordability, and value. So really what you're doing is you're contrasting the business characteristics and purchase price against what you had established in module 1, being how much can you afford and is it a fit for you? This is where Village Wealth is building software. I have a few slides to show on that. And so again, comparing with your skills, compare with your search criteria, calculating the bankability, and does the value make sense as to what they're asking or what you think they would be willing to accept if you have that information. This is what Village Wealth is building software for right now. It's being able to evaluate these companies with data-driven decisions. So I'm just showing you some mock-ups on what's being developed with Village Wealth. This is where the inputs of any investors that you have would go in and how you look at structuring the deal. And it compiles all these inputs to be able to give you a sense of how long is it going to take to pay that business down, and what does the cash flow in the business look like as you pay down debt. That's the red line. And the green line is your free cash flow as it continues to rise as you pay down that debt and grow the business during your ownership. Module 4 is where you submit the non-binding letter of intent. That's where an earnout may come into conversation and where you hit negotiations. So once you put in that first letter of intent, again, it's a non-binding agreement, and it usually talks about what's going to happen throughout the rest of the process. It's a mutually signed agreement that is allows people to proceed through due diligence and gives you exclusivity. So once a seller has accepted your letter of intent, nobody else is looking at this business. It's your time to dig in and do due diligence, and things can change. The terms that you originally proposed in your letter of intent can change because maybe you find things in due diligence, and so you can't get too hung up on your original terms, because it's very common that they'll change. And it's essentially, this is an instruction manual for the lawyer to create the definitive purchase agreement, which is the binding piece. I mentioned an earnout here because it is a mechanism that's used when there's a misalignment of value, where a buyer says, well, I'm only willing to pay this. And the seller goes, well, if you want it, I'm only willing to accept, this. And sometimes an earnout it's almost like a royalty, where if the business is performing, that a percentage of the compensation to the seller is received based on milestones. And there's lots of different ways this can look. If we had more time, I would get into it in more detail, but I'm planting it as a seed so you can take it away and learn from it, to learn more about it. It was interesting. We did a webinar last week, and the lawyer said, if you're going to do an earnout, be prepared for a lawsuit. So she sees lawsuits come back on earnout. I've never heard that before. That was new information to me. So definitely it's something that the lawyer does come in and have quite a bit of input in. And again, why you want to be using an experienced lawyer if you're going to be embedding terms like this into your transaction. And again, I like my visuals. Here's where an earnout is in there to basically bridge the gap between a buyer and seller and price. That's where it usually comes in. It usually comes in later on in negotiations. And if there is a dispute or you just can't come to terms, that's usually what bridges the value gap. Negotiations, when you're putting in that letter of intent, that's where you really are supporting your rationale as to why you're offering this. You're understanding how to creatively structure the deal. Again, are you bringing in co-investors? How are you affording to support what you're offering to pay? Understanding the seller's values. Really, this is why I encourage meet the business owners, understand what's most important to them, because there are some non-financial terms that can really position your offer. If it's a competitive bid situation, there's other buyers at the table. You want to think about those other non-financial items. We've seen people structure in equity for key employees where the long-term employees actually got gifted equity as part of the sale. That was really important to the business seller, because they know that they're walking away with a nice big paycheck, and they weren't the only ones that got them there, and the employees deserve a piece of that. So sometimes there can be option plans that are negotiated into the sale, and incentives for employees to stay on. And terms can change. So again, we get people hung up on the offer stage. It's non-binding. Lots of things change. It's still a very fluid situation. You're not locked in for life. So understanding and really knowing that things can change between the letter of intent and the purchase agreement. There's a lot of fluidity in that time space that can happen. The last piece is the bank application, different types of due diligence, and the definitive purchase and sale agreement. Stage 5. So here's a list of what the banks will request. It is a tedious process to have everything prepared for the banks. Due diligence for a buyer or a seller is both in depth. It's a very exhaustive process, but the more prepared that you can be, the more successful you'll be at it. So they're going to ask you for the personal net worth statement. They ask you for your background, your motivation, things we've already talked about. They want to see a signed letter of intent when you go to the banks. Where's the business you're buying? Where's the letter of intent? We've seen banks ask for the definitive purchase and sale agreement, push back and tell them, I have a letter of intent. I don't have the definitive purchase agreement yet, because really, as soon as you get that letter of intent signed, that's when you're starting to work on financing. So I think some of the banks have started to change their request for information on this piece, but certainly it starts when there's a letter of intent. They're going to ask for the 3 to 5 years of the business's financials. They're going to ask for business information as provided by the seller. So that's where, if there is a SIM, they want to see that. They want to understand what the transition plan is between you and the seller. Is the seller staying? What are they doing to support you? And they want to see a forecast. They are going to want to see what you're going to do with the business under your ownership for the next 2 to 3 years. And this is something that we often see people overlook, or they don't realize they need until they're midway through financing, and then it takes time to prepare this. So as early as you can understand that you're going to need it, the more it will help the process. This is kind of the fun stuff that we're seeing right now. Interest rate, prime plus 3 to 4.25, loan terms 3 to 7 years. So if you're thinking of, how does this relate to commercial real estate, or am I going to get an amortization period for 30 years? It's not that long. It's much shorter terms for business acquisitions. What we're seeing is principal holiday up to 12 months for on maybe 65% of the deals we're seeing have a principal holiday where you're only paying interest. This is the fun part. You get to only pay interest for the first year of ownership. And some of the banks are doing that to really give you a bit of a buffer so you can get your head wrapped around the operations of the company as you take over ownership. It's one of the nice things that we see them do. Buyer's equity, again, that 10 to 50% range. Balloon payments, sometimes they do want to see balloon payments, or we're seeing balloon payments in vendor financing. Cash sweeps is when, if there's a different additional profitability in the company in the course of a year, sometimes they're going, well, we're going to take some of that to pay down the loan. Not in all cases, but in some. Lenders covering closing costs. You have lawyer expenses and accounting firm expenses, and sometimes you can roll those into the loan if there's enough cash flow in the company to support the extra debt servicing. And be prepared to provide a personal guarantee. There are some exceptions, but the banks do want to see a personal guarantee. So that means you may be putting up your home for collateral. So you really want to be serious that this is the path for you in buying a business. So it does get very personal. Due diligence, types of due diligence. So due diligence is the thorough review of the company being acquired to verify that all aspects of the business are what you thought them to be. And there are different areas where you're going to do due diligence: legal, financial, operational, HR, maybe the technology use that they have. And this is usually the period between the letter of intent and the definitive purchase agreement, where you get in and you can see under the hood, and it's almost like an audit in every area of the business. It's very invasive and thorough. So business owners really, hopefully they're working with an advisor who's preparing them for this stage, because you can ask for anything, and this is where you get to see everything. This is what due diligence can include. We're running out of time, so I'm not going to go through the list, but you've got it on the slides that we'll attach for you later on. Again, the definitive purchase and sale agreement is the technical term for the documents that the lawyers are going to put together. Again, making sure this is not just a bill of sale for assets. If you're buying a company that's got intangible assets, if there's goodwill involved, you really want to work with that M&A lawyer who's a professional and they're a niche specialist in these types of documents. So as you can read through on your own time, you can see what's all involved in the definitive purchase agreement, which PSA is the short form for how it's referred. We've thrown in just a sample. People are kind of like, how does this work? How does this time frames all play together? So we've just included a bit of a timeline. This is a 1-year timeline. So people are, always exploring, how much time does it take to find a business and buy the business. Typically, finding the business can range, like the search period can range from months to years. Negotiations are fairly quick. The purchase and sale agreement, again, fairly quick. It's the real time consuming pieces. Raising capital, if you're going to raise capital, that can be a little bit longer. The search is longer. And then financing and due diligence can range from 45 to 60 days is what we're seeing from financing. But the due diligence piece, we often very, very much, usually from the letter of intent, we're seeing people, the date that they're putting on closing is usually 2 to 4 months out from the letter of intent. Sellers always want to close faster. What's realistic can sometimes be a different timetable. From letter of intent to closing, oftentimes we see that there's oftentimes an extension written into that, where, okay, we're not going to meet our deadline. We're going to write an extension. Very, very, very common to see an extension to closing, before closing. So here's kind of a big picture, all of these pieces and all of these stages all in one. We have a number of programs that we run over these modules. Our preparation plan is a coaching program. It involves 3 coaching sessions and roundtables that you meet every month with other buyers, and it covers modules 1, 2, and 3. Once you find a business to buy, that's when people usually step up to acquire well, and we start working with you to do the letter of intent all the way, and we're there until closing. We've got a WhatsApp chat going with one of our buyers right now, and the last message I saw from the buyer today was that the seller's signing the documents in 20 minutes. So we're right there. We're there with you through all the way through closing, to be there as a coach, as well as there to help you find financing. So our programs are an outline of this. So we've got Buyer Lite, which is our free version, gives you access to the webinar series, gives you access to the marketplace, in-app messaging with sellers. And our newest piece is the digital community that Bridget is managing, and the app's going to be available for download in the next few weeks, which we're so excited about. Our preparation plan, that's search and prep coaching. We really help you get to a comfortable place where you can do the search yourself. You're understanding how to engage with business owners, and you're evaluating companies in the right way that works for you. We do the members only roundtables. This is the roundtables that are more private and intimate, are for members only. It's $50 a month paid annually, so it's $600 for the year. We also give you templates on the letter of intent, as well as a number of other templates and tools to use. And Acquire Well is our finance concierge. So that's where we take your deal and we tender it out to the banks, and we find you the best banking partner for your deal, and we help you negotiate the terms of your loan. So that's where we're in it with you. We're on like I said, a WhatsApp channel, and this is where we're building software for us to be able to help more people move through the acquisition process. So that's all I've got for today. I'm sorry, I'm happy to stay on. I'm available to stay on for questions, and we can continue to chit chat. But if you have to run at noon, thanks for tuning in and joining us. And yeah, with that, we can hang out and answer some questions.